Hi, everyone. Welcome to FinFactor. I'm your host, Blaine Bertsch, co-founder and CEO at Dry Run, where we will help you forecast your cash flow, model scenarios, roll up budgets, all the things you need to know where your business is headed. And I'm really excited to have joining me today someone we do podcast with every week on one of my other podcasts, Mike Milan, also known as Cash Flow Mike, which is why he's on FinFactor, because he is the expert in cash flow. Thanks for coming on this show, Mike.
Man, I can't believe this is 2 podcasts in 1 week with you. This is going to be the most fantastic week ever. Anytime I spend time with you is great. This is the perfect venue for what you're doing, though. This FinFactor, bringing finance professionals in with their expertise. We tend to be on the more casual side on our other podcasts, so this is one we can really dial in with what we do on a professional basis.
Yeah, and it's and we've talked about like the topic today, the financial gap. We've talked about before. Little bits here and there, but to be able to have you go into this in depth is just going to be so cool and so valuable. And like you said, it's like so many companies, they know how much money they've got. They don't know how much money they're going to need. I want you to pick up from there and explain a little bit about the financial gap, and then let's get into the nuts and bolts.
Yeah, generally most companies that experience cash flow problems, it's one of those things that I describe as clunky, right? You're always waiting for money to come in, while you're trying to make another payment. And most of the time when we do financial analysis, we're looking at things in silos. We look at how much inventory or how long it sits on the shelf, or how long does it take us to get paid by our customers, or how long does it take us to pay our vendors? Well, those things don't happen in silos. They happen simultaneously and overlapping. So this concept of the financial gap is theoretically the amount of time where your company has run out of money, right? You're waiting for more money to come in and you've paid all your bills. That gap, the length of the gap, if that's why I call it that, determines how much money you need, right? And think about a gap. Is it easier to jump over a small gap or a large gap?
Yeah, exactly. And
that's right.
Now we do have we talked about this right before the show that you call it clunky, I call it lumpy. We've had this debate for quite a while, but it's a problem we see with our customers over and over and over again. And we're talking there's companies these are big businesses, well capitalized, a lot of money floating around out there, but they got a ton of receivables, a ton of age receivables. Like we're talking 500,000 age receivables and another 500,000 in receivables that they got to wait on, and they got to pay these bills. And it's the timing of all of these things that creates the gap, because you don't want to hold out on, you got to pay your bills, right?
Yeah, and there's actually 2 calculations that help you understand what type of gap you're covering, right? So one of them's for inventory-based companies, and the other one's for a service-based company, because people always say, well, I don't have inventory. Okay, well, here's how you do the calculation on your side. And the calculation is pretty simple. I'll just tell you. I know it's easy to do math on a podcast, but and I'll tell the story first, and then it'll explain the math. So the story is this, right? I mean, you order inventory, right? You're going to order inventory for somebody. The vendor brings it, and they set that inventory in your warehouse, and it sits there for a certain amount of time. But when they give it to you, they give you an invoice. And so you take that invoice, and what do you do with it? Well, you throw it on your desk, right? And that invoice sits on your desk for a certain number of days. These are happening at the same time. Then somebody comes along and buys a piece of your inventory. And instead of getting cash, you give it on credit, or you give that customer an invoice. Then what do they do with your invoice? Well, they take it and go put it on their desk, right? And it sits there for a certain amount of time. So then you pay your invoice, but you haven't been paid yet. The difference between that money coming in, which is inventory plus AR, and money going out, your AP, is the financial gap. So think about it this way. The math is inventory days plus AR days minus AP days equals the financial gap.
Okay, I'll have to put that in the show notes, because it is it's simple.
Yeah,
it's simple, but when you explain it that way, it's like, yep, that makes perfect sense, right? And if you have a gap in there, like if you're gonna have a shortfall, it's gonna show up right there.
Yeah, and I think the biggest thing to remember there is, because we're calling it a gap, you want that number to be as small as possible, right? So you want to do things that create a smaller number, like hold less inventory, or make it turn faster, or collect faster, or pay a little slower. That reduces the size of those gaps, those 3 moves. So, a couple big stories that kind of brings this home. You remember Dell Computers, right?
Yep.
Not remember, because they're like the number 1 computer company in the world right now, besides Apple. But early on, if you remember, like in the probably late 1900s, early, I know you like it when I say that, early 2000s, Dell actually sold their computers to you first, right? You built it. You say, hey, I want this screen, I want this CPU, this much memory, this type of mouse. And you kind of created it with this checklist order form that they had, either on the internet or on a piece of paper, and sent it in. So, but with that, you sent the money. So I sent my order and I sent the money, and 4 to 6 weeks later, a Dell computer shows up at your house. So think about what they were doing. They were collecting the money up front, building the product, and sending it back out. They didn't have a receivables problem. They didn't have an inventory problem, right? Because they only bought what they needed to build. Then came along CompuServe and Best Buys and all these other big box electronic stores. Dell had to change its business model. It couldn't just sit in a factory and build these things and ship them out when you ordered them. They had to build them up front, put them on the big box shelf, and wait for somebody to buy it, and then wait to get paid, right? So all of their inventory was now front loaded. Well, think about that. That's where like Michael Dell was thinking about growth. He was just trying to get more sales in the door. He says, well, that's a whole new channel. I don't have to wait for orders to come in. I can actually go put inventory out there and people will buy just automatically with no touch. Well, when he did that, that's where his quote comes from, is we were spending so much time looking at the speedometer that we forgot to look at the gas gauge, right? And what he meant by that was the speedometer was sales. Sales were increasing, speed was going faster, but they were running out of gas, right? Because they didn't realize how much money up front it would take and how long it would take to get paid. So that's kind of an example of how this works.
And it's it's funny. Like we talk about this kind of stuff all the time too, where that time slips away because it's like you don't it doesn't register all the time that it's like, well, yeah, I got my contract and I start doing the work and then I invoice them and then it's net 30, but then they pay late and you start adding them up. And we've talked, I know you have, we talk with businesses all the time, and sometimes you're talking with them and finding out that, from when they'll start a project to the point where they're actually get their first payment, their first cash in the door, it could be 180 days. Like think about that, like 120, 180, and that's not weird. That's just how it is. And with some solid adjustments in how they set up their projects and the way they negotiate and how they do their billing and how all of the systems and processes in place can actually shorten that up. And all of a sudden it's like, yeah, you got your first payment within 30 days because you got something up front. And then you got this here that was actually into 90 days. But before we get into those types of service businesses, I want to dive in a little bit more on this inventory because we've talked a little bit about that before too. Like some of the challenges of inventory, and I know you have some stories from some of your clients about having inventory sitting there that they don't realize how detrimental that can be to their business.
Yeah, so that's also kind of interesting too, right? Which is, I had a tire business. Think about tires. They're not interesting to me, but still, I mean, it's inventory that's sitting there. So I had a business owner with a tire shop that I was working with, and the first thing every business owner wants to do with their consultant or advisor is take you on a tour of their place. Hey, let me show you what I got, right? So, and this tire shop is just kind of regular. It's just, you go in, there's a front desk, there's a little waiting area, it's maybe some coffee there, then they got the bays where they change the tires, and then out behind the bays is this little warehouse that they had all the tires in. Well, this is in a rural area, and so they have some tractor type tires. So I'm going in there and I'm looking through it, and tires aren't my thing, but I see this huge set of tires. I mean, bigger than I am. I mean, they were just massive tires, and I'm counting them. And I go, man, how many are there? Like 5, 10, 15, or 16 of these tires on the shelf. I said, how much those cost? He said, they're $3,500 a piece. I'm like going, shoot, that's $50,000, just those tires sitting there. I said, well, how many of those do you sell in a month? He goes, I don't know, sometimes 2, 3. Whoever has a flat, we got them. That's why we keep so many, is because we're the guy that's got them here in town. I said, well, why do you carry 15, 16 of them? I said, how long does it take you to get them? Like 6 months? He goes, oh, no, we can get them in about 3 weeks. Well, I'm like going, you only need, because there's a calculation that tells you the exact amount that you need, so you never overorder, you never underorder. It's called PAR. It's periodic automatic reordering, and it's set up by a lot of big companies, but little companies can use it too. And the calculation is pretty simple. And it's how many do you sell per month, right? Just units, divided by the number of times you can get it per month, right? And then I always add in like a little safety amount, maybe one, just in case there's a run on them that week, or something like that. But if you can get something every week, that's 4 times a month. So if I'm selling 100, I don't need to buy 100. I do 100 divided by 4 because I can get it 4 times in a month. I only need 25. You're going to keep more money in your pocket. He only needs about $15,000 or so in product. 10 to 15, not 50. Think about the extra 40 grand he could have in his own pocket.
And the amazing thing, so those of course are really expensive giant tires, a great example. But imagine that there's probably groups of tires where they do a lot of turnover, where they're really common sizes, and they carry probably a lot of it. And imagine if you did that, not necessarily in every tire in the entire place, because a small business, that's tough for them to do. Maybe there's software that can help them with that. That would be actually cost effective for a small business. That's always the tricky part. But I bet you, just like those big tires, there might be 3 or 4 gaps there that they can go, let's just fix these ones. And suddenly you've got like you said, like 50 grand down to like 15 grand. If he has that sort of bucket, several other buckets in his business, he might have another 75, 80 grand in his pocket, and it's just running much more smoothly.
Yeah, so where I got good at that, Blaine, was I ran 3 restaurants at one time, right? So when you got thousands of dollars a week going out in new orders, food, drinks, alcohol, those type of things, you learn really fast how not to overbuy, right? If you overbuy on steaks, guess what you're going to be doing? You're going to be taking steaks home before they go bad. Or your employees will help you eat them. It's one of those things. But it doesn't matter the volume. I just told you the one story about one set of tires, but you're right. That same mentality that he had on the big tires carried through to all the other tires, right? And another client does water repair, waterproofing for basements. And they just kind of guessed what was in their inventory. And then as they needed things for the jobs, they would just go to Home Depot. I say, hey, can you help me? Can you just do one thing for me? Can you just go count and see what you got in there, in the warehouse? So it took him about 2 weeks to count it, just because it's not something he wanted to do. And I said, well, if I told you there was money sitting in there, would you go count it? And he goes, yeah. It's okay, we'll go count it. So he goes in. He thinks there's $50,000 worth of stuff in there. There was $146,000 of stuff in there. 146. Think about it. He's almost $100,000 off just on what he thinks. And that's what he gives the accountant. 50, just write down 50. There's 150. And it's stuff he uses every day, but it's sitting there. Instead, he allows his crews to go to Home Depot 2 or 3 times a day to pick up what they need. I said, can we try one process? I said, I can put $50,000 back in your pocket this quarter. Well, how are you going to do that? When they come in the morning to pick up their trucks, have them get some of the stuff that they need off the shelf instead of going to Home Depot. Like, treat that like Home Depot for a while. You won't be making Home Depot purchases. You'll be running your inventory down to the right level, and you won't have any money going out of your pocket. It's already out of your pocket. Dude, it put 50 grand in his pocket in 3 months.
Yeah, and I'll argue that it was actually more than 50 grand, because think of how much time they saved from all of those different staff and all the different crews going to Home Depot every day, because they did it more than once too. That time, like the amount of money that they're moving through there, and then the way you just mentioned, that calculation for having inventory on the shelf. Well, that's the other side of it, is if they can go to Home Depot and just buy it, that's same day. So that calculation doesn't even add up. So unless he can buy some of those things they're using a lot on a wholesale rate at a larger bulk order, he shouldn't even be holding inventory for some of that stuff. So it's amazing, like how much 146 grand sitting on the shelf and an hour or 2 a day, maybe more, of his crew driving to Home Depot and burning through gas and everything else.
We made 2 or 3 what I call bite-sized consumable chunks of changes, right? Just little things that we did like that. Like, hey, just look at your job, go pick some things that you think you're going to use. That was the biggest change, right? Yeah. The first 6 months of 2022, this company lost $200,000. He hired me January 2023. At the end of 2022, he lost almost $450,000. Yeah. We changed it 180 degrees. By the end of 23, he made $450,000 and got an offer on his company for $3.5 million when it wasn't even for sale or whatever before that. So think about it. In 1 year, a few little changes changed his whole life.
Yeah, it's unbelievable how much of a difference some of these things, systems and processes in place, can have on a business. And like you're talking about, we're not talking like a few percent swing. Like you're talking about burning $500,000 cash to making $500,000. It's almost $1 million swing there for a small business with everything they have right there. Just some smart changes.
He had run this company for 35 years. He was in tears at just the change. He saw a dream materialize. He'd always wanted to buy another house in Florida. And he saw it materialize in 1 year. We were thinking a 5-year time period, and it happened in 1 year. Yeah. It's crazy.
It's amazing. So, okay. So we talked a little bit about because inventory is obviously, like, you've dug into that a little bit. That's a real problem. And we can see where that gap can happen, but let's dive in now to some of the service businesses. Like that's where a lot of businesses that we serve are service businesses. You and I talked about a lot, the lumpy cash flow and how much money is left on the table. It's like, for inventory, it's how much money is left on the table. With businesses, it's the hours that your staff are sitting idle, where you're not right up to capacity, but to that ideal sort of 80% range in capacity. You're not running over capacity. We've done the calculations, and we know service businesses on average leave 21% of their revenue on the table. They just flushed away. So talk a little bit about that type of business.
Hey, I've got to tell you that's where I think I earned the nickname Cash Flow Mike. When it comes right down to it. I mean, my first business that was real, I took a janitorial company and morphed it into a hotel staffing company. All I was doing was selling people's time, right? Into this. And I worked with full service, high-end hotels and resorts, and quickly became a preferred vendor for Marriott and Hilton and Hyatt and those type of things. Opened 27 offices in 9 states in 3 years, right? Cranking through it. And almost lost my relationship, maxed out my credit cards, took their home equity line. I'm like, you're like, oh, damn, this guy's good. Yeah, except for all the stress.
Yeah, exactly.
Trying to keep up with it, right? So, and it was this. That's when I learned about the financial gap. Like, am I going? Why is it like? How can I be so successful? I was seeing so much money on paper. I was paying tax on money I didn't have that I hadn't seen. Right? Here it is. I'm making this profit, but I don't have any money. Well, what was happening at that point in time is that Marriott was paying me in about 90 days. So think about that. I have a crew go to work. They work for a week. I send you an invoice that week. Next week, send you another invoice. Next week, send you another invoice. So every week, 3 months later, I get the first payment for the first invoice.
Yeah.
So think about what I'm doing in the meantime. What do you think's happening on my side? Employees are getting paid every 2 weeks. Guess who you can't wait 90 days to pay? It's like, hey, employees, when Marriott pays me, I'll pay you. Yeah, they ain't flying, right? A, it's illegal. B, who would work for a company like that? Yeah. So I'm making payroll. That's where I'm grabbing money wherever I could. I got in the restaurant business partly to solve that problem, which was, or at least in restaurants, I got cash coming in every day. I can kind of, loosen up my burden just a little bit. But I finally just got to a position where I had to go to Marriott and say, hey, listen, I realize that it's a thing where you want to stretch your payables, where you want to sit on invoices as long as you possibly can and then make the payment. I get it. I said, but that's okay to do with paper towels. These are people. You can do that with a paper towel company, not with people and people's paychecks and a young company like mine. I said, I need you to do something. I need you to pay a little bit closer to payroll, because if you would have had to hire these folks, you got to pay them every 2 weeks. So you're already getting quite a big benefit by waiting as long as you are.
Yeah.
That one conversation, I had that conversation with about 20 different hotels. It took my days receivables, right? How long it took me to pay from an average of almost 90 days to almost 40 days. Do you want to talk about the life-changing difference that made, right? Just shortening that time to collect. So yeah, that's a huge thing that I'm very passionate about.
Well, and it always comes down to people do business with people. Relationships matter more than anyone thinks, even today. It would be easy, I think, to look at the numbers and purely look at, okay, if there's a problem in the numbers, there must be a solution in the numbers. But as you've sort of outlined, there's a problem in the numbers. The solution is generally with systems, processes, and people. Mm-hmm. And the business owner understanding, not just knowing, but understanding what the problem is, and then knowing the answer, like the process is going to take them out of that problem, but also the ability to negotiate can save a business, and can also take a numbers problem like this and turn it into something that works. You have to understand. You have to know it and understand it. Then you can maybe do something about it.
Well, I would say to recognize that early, and don't wait till you're not sleeping, till your credit cards are maxed out, and all the things that I did wrong. I would say if you hear this and listen to it today, save somebody's relationships, even their personal relationships are probably struggling if all these other things are struggling as well.
Yeah, that's the other end of the stick. It's like it's not just about relationships with in your business with your clients and that. It's also everything else around you as a business owner. Like, we talk with, and I know you do as well. We talk with financial professionals all the time that are advising businesses, and I always know the ones that really get it are the ones that are empathetic to the business owner. It's not, like, oh, well, they're dumb, they're doing this, or these numbers don't line up, or they just like, here, let's show them what happened last year. They're looking at it and they're looking at it and saying, okay, how can we help? This is a business that's got some really good things going on. How can we help them thrive? How can we help them grow? And that's sort of the next thing that I kind of wanted to sort of tackle with this. So you've got this financial gap. How, as an advisor, a pro, whether you're like a CFO, a controller, or a CPA that's offering some advice to a client, how do you take this and make it kind of actionable?
You know what's funny is that I'm actually writing a book about this right now. So you inspired me to write another book, apparently. You write one, I got to write one. I got to keep up with the Blaines of the world. But it's going to be called "Don't Tell Me What to Do," right? And it's more about I teach accountants and bookkeepers how to have better conversations, financial conversations with clients, right? That's kind of, I'm glad you brought that up, because that's kind of what I do. I didn't realize the disconnect. Sometimes it's about the numbers and doing the calculations, giving the advice. Sometimes it's about the delivery of the advice, right? Mm-hmm. That's the barrier. So, in this whole concept, I'm calling it the client conversation coach, and it's like 8 different techniques on how to talk to people on different things, and it's 3 phases, right? I call it a harmony phase, which is about building and getting agreement. There's a depth phase, and that's how to kind of uncover some of the hidden problems that they have. And then there's an elevate phase, and that's about giving them what I call an economic echo, seeing that their actions actually have an echo that come back in the form of dollars. So, it's one of those things where I'm trying to build all 3 phases of the game, right? Yeah, like football, you have offense, defense, and special teams. So you got beginning, end, and in the middle. So, but here's where I got the idea. Have you ever seen the show Hoarders?
Yes.
All right. So this is, I've watched 13 seasons now, and not because I'm a fan of, and not because I'm a fan of hoarding. It is strictly that I am a student of how the psychologist talks to somebody with a hoarding disorder. Now, here's the thing. Think about this. I'm like, because this is how I think some business owner, client, or consultant relationships start. You got to remember, when you're the advisor, you're the outside guy, so you're the doctor. And the person that runs the business, it's their business, but their business is maybe a financial mess, right? So I look at that, the business, anything that's out of order seems to be like the horde. So the first time, you know this guy knows that the doctor's coming because they meet at the door, but with the film crew, so they know it's coming. But this is like the first interaction, to me, that could be the most volatile, where the guy, opening up the door and behind him is this colossal mess and just everything just in chaos behind him, and the doctor can see past him to it. That's when everything can fall apart, right? Instantly. The guy is, what do you think he is? He's defensive. He's sitting there. He's like, oh my God, he's going to see this.
Yep.
That first sentence that a doctor says is the thing that hooked me into this show. They'll look past the person with the disorder and say, hey, tell me what I'm looking at here. That's how they start. It's not adversarial. Everybody knows it's a mess. He knows it's a mess. But what I love about it is that it's so disarming and so powerful in the fact that it allows the person to justify it. Hey, just tell me what I'm looking at. So the guy goes in to go, oh, well, yeah, this kind of started. I'm going to fix this and I can sell this for money. And they got these reasons why this happens. And that's what the business owner does with me, the client. He's got these reasons why it happens. And that's one of the extra techniques is to say, hey, well, how do you think it got like this? Right? And if you listen to the doctor, these conversations are just amazing transformations of getting somebody to not even know there's a problem to taking action near the end of the show. I approach my clients the same way, and I do it with this thing called the economic echo. And what that is translating why it's important into dollars. It's called financial impact. Because you're not like this, you're leaving these dollars on the table is the basic premise. But it's a lot more elegant than that, but that's kind of what happens.
And it really brings to light again the power of a question. The number one thing you can do is ask questions. And in fact, I've shared this on probably one of my other podcasts, but I always have to remind myself to ask questions because it's sometimes my go-to, my head's spinning and thinking, and I'm pushing shit out and everything, and I'm like, no, ask questions and dig in and figure out what works, and it's a habit that is so powerful that I'm always working on. But I know for someone that's advising businesses, that's just your most powerful tool, asking the questions and having a bit of guidance on how you start and what questions to ask can be transforming for them.
Yeah, and the reason I called the book, Don't Tell Me What to Do is, hey, I don't like nobody tell me what to do. But nobody does, right? Nobody does, right? But I'm logical, I'm reasonable, I can be convinced that it's the right thing to do. I just don't. So the approach is different. So it isn't just asking a question, it's asking it in a way that makes me go, yeah, you're right. And in the highway patrol, remember I was a state trooper way back in the day, they taught us techniques called verbal judo, right? It's the ability to just talk to somebody and get them to see what's really happening. And the whole process, the whole philosophy there was, hey, it's better to talk for 30 minutes than fight for 3, right? Yeah. So, yeah, it's just better. So the way they taught us to just talk to people, in the Missouri Highway Patrol is just fantastic. Like on, hey, if you were like this, what would you think? If you were doing this, if you saw that, and it's a mirror technique at the same time where I would even tell stories about other things that were happening that were similar to what they were doing. I say, hey man, if you saw somebody doing that, what would you think? What would you do? Really, I would say, hey, you're doing those things, right? And that's how I talk to business owners, right? I'll tell them a story about another business that has the same problem, and they can see themselves in the mirror, right? It creates a little bit of self-awareness, and that actually opens you up to being a little bit more agreeable without acknowledging that you're at fault, right? I'm not pointing the finger at you. I'm telling, no, that's somebody else. That guy's the bad guy, not us. We're just here to solve this problem.
And which is important because like we've talked about with business owners, like and especially right now, the environment out there it's tough. There are so many businesses that aren't profitable. They're burning cash. There's a lot of stress. There's a lot of anxiety, a lot of challenges. It's a lot of not a light at the end of the tunnel. Really, it's like, yeah, it's going to be a long slog here, and there needs to be a really effective, but sometimes a bit of a gentler, understanding approach, right? And the end goal is to improve the business, and it's how do you do that? And it's those conversations that are absolutely key.
Well, what I'm teaching the accountants and bookkeepers now is I say, stop trying to get compliance from your clients, get commitment. So you're not just telling them what to do or saying if they do this, then this will happen. That's compliance. And you're just forcing them to take an action that is beneficial, but at the same time, they didn't come up with it, right? So you got to get commitment that this is the right thing to do. I mean, what would you do in this case? You know, how would you approach this different? You know, I mean, just getting them to come up with the answer before you say it. Like, you know, hey, what do you think's going on here? Then they'll say, well, I think it's operating expense. You know what? I did some analysis. I do too. I think it is too. Let's dig into that. Don't you think? I mean, I'm telling him he's spending too much money, but I'm doing it where he came up with it. Just by the way I've asked the questions.
Yeah, it's like I had an accountant I was talking with not too long ago, and was telling me the challenge of advising businesses is that he was trained with historics. That's all their training. Tax and compliance is historics, penny perfect, historics, penny perfect. And he was like, how do I change that mentality? How do I talk with customers about this? How do I change my mindset? And I just kind of moved to a different part of the conversation and said, well, what are you planning to do in your business this year? Because it was his own company and he was looking for clients. And it was amazing how much it transformed, because then he's starting to think about what he wants to accomplish this year, how he wants to expand his business, and then like you have the mindset, you have the understanding, you're just not relating it, you're not tapping into it, that the way you're thinking about your business is the way your customer's thinking about their business. Like you can talk with them as an entrepreneur.
Yeah, it's a teammate mindset, right? I'm part of your team. I'm not your boss. I'm not law enforcement. I'm just part of the team. So how would you operate in a team? You wouldn't just bully people around and tell them what to do, right? That's just human nature. Nobody likes to be told that stuff.
Yeah, exactly. Now, I want to circle this back to the financial gap and these two sort of the inventory metric and the service business metrics. When and where should that sort of be presented to a client? Is that a really good sort of maybe kickoff to starting an advisory and engagement, or is it something that comes a bit later? Like how would you use that exact financial gap to start those conversations?
I actually have another technique I would do before this one, and I call it mining your business for hidden cash, and it kind of points me in a direction because it's divided into two different groups. One is cash generating activity. So think about that as vertical. It starts at sales and you take away things, operating expenses, those type of things until you get a profit. It's a vertical type of analysis. The second half of it is called cash conversion activities, right? So think about that as horizontal analysis. It's timing. How long does it take these things to happen? When I do that, it will typically point to if they have a cash conversion problem. That's really what this financial gap is about, is a cash conversion cycle. So when I see that there's a cash conversion problem, not necessarily a pricing or an expense problem, then I take them to the next step, which is, I call it the fast money formula, because I want money to move fast. Faster it goes, the smaller the gap, right? So that's when I move into it, because when I identify that the problem is cash conversion and not something else, it's not their price, it's not how they spend money again, but it's cash conversion, it's timing. Then I show them on using that formula that I call the fast money formula, AR minus or inventory plus AR minus AP equals the financial gap. I show them. Now, Blaine, I mean, you're an app guy. You built Dry Run. I built the Clear Path to Cash, which is a financial app that does these calculations for you. And so I built these cool little sliders in there where we can do what if scenarios. Hey, what if we had a little less inventory? What if we collected a couple days faster? What if we sat on an invoice a couple days later? And just to see what happens to the gap. What you have to do from there, once we identify there is a gap, we have to compare it to how much money we have. And that number that's used by banks or investors is called working capital, right? It's current assets minus current liabilities. That's how much you have. It's pretty easy to come up with. But then you take how much money you're spending, either on inventory or operating expense, doesn't matter to me which one you want to use. I usually optimize for inventory because that's what I would get a line of credit if I needed it. I would get it against the inventory for working capital. But I would say I'm spending on average X number of dollars. And how do you determine that? Cost of goods sold divided by 365 turns it into an average daily spend. Well, once I know what I'm spending per day, I multiply that by the gap days. I need that much money to cover that gap. And then I compare the result to the working capital. Is there a shortage or not? And on a podcast probably doesn't work to explain it, but just know that there's a calculation for how much you have, working capital. There's a calculation for how much you need, and that's called the cash shortage calculation. And that determines or compares how much you have versus how much you need.
Yeah, and of course, anyone listening to the show here, you can go to cashflowmike.com or you reach out to us and we can get you in touch. These are all first of all, the calculations are there. They're fairly straightforward. But what I think the overall picture here is that being able to walk into a business and you're helping them move that business forward, you're taking an advisory role with the business. There are just some simple and clear ways that you can take a step and help them, like you said, not telling them show them and help them come to the understanding of here's where it's at. Here's step one, here's where it's at. Step two, here's where it's at. And you can start to look at where the problems are, and then you're looking at, okay, how do we fix those problems? Well, how can we remedy those?
Yeah, I mean, to me, you can only handle so much information at a time. So I try to break it down into those little steps. And what you're also doing is collecting quick wins. And they go, oh, that worked. Then that worked. Then that worked. And all of a sudden you've got a massive snowball of wins that are doing and generating a lot of cash for you.
Yeah, it's like lifting the water level. It's just a bunch of little things that you do. This again, like an engagement like this to really have a fundamental difference on a business. This is not a 1 hour meet and greet. This is a dedicated, regular engagement that likely can go on for a really extended amount of time. Almost is, for some businesses, probably indefinitely, because it's just constantly finding where things are underperforming a bit and fixing them. And maybe the wins aren't those $450,000 in 1 year, but when they're $45,000 every quarter, because you're just constantly improving the business, it's moving the ball forward.
Yeah, and if you're getting them wins, they're not going to leave you. You become part of the business now. You become part of it. And for a decade, I had a bad taste in my mouth about consultants, advisors, right? In 2007, I hired one for the restaurants. And they came in as a team, two guys. Came in as a team. They kind of asked me about the business, and they asked me that question. Hey, what do you think's going on? I said, well, I think I've got kind of a pricing problem. I've got kind of low employee morale because of this other issue, and there might be some inventory control problems. 2 weeks, they go back to their office. They came and produced almost a 1.5, 2 inch binder of stuff. And it said, I had a pricing problem, I had an inventory control problem, and a morale problem that was causing all my stuff, but no real solid reason. Like, well, wait a second, I just told you what it was and you put it in a book and gave it back to me. So I did not trust consultants after that for a long time.
The quality varies greatly, and but sort of proof is in the pudding when you and the fact that you can show them with their own data where they left money on the table. And the most important thing is, it's not just, okay, here's what happened last year. It's here's how we can move it forward and improve it this year. It's the same when we're talking in dry run. We're saying we can show you last year the money left on the table, especially with the valleys in your cash. and in your sales pipeline. But most importantly, let's take a look and start to spot those trends far enough ahead that you can do something about it. Because it's not like there's not much point to going, well, that's what happened last year. Well, hopefully it's better this year. No, This is how we're going to change things to move the needle for you guys.
I like how you use hopefully. When my clients use the word hope, I would say, hey, listen, we're not smoking hopium here. Let's get real.
Yeah. Yeah, exactly. It's that's where the rubber hits the road. Well, this has been a great episode, Mike. This has been so interesting to dig into this. I know you and I can talk about different financial concepts and things probably endlessly for till the end of time, but this was a great topic for today, talking about the financial gap and getting into some of the ways that you can actually talk to your clients about this and actually move the needle a bit here is super valuable. So tell me a little bit about, before we end the show here, some of the things that you do to help advisors, help businesses, and how they can get in touch with you.
Yeah, basically what I have is at cashflowmike.com. I sell courses, right? I sell really two courses. One course is about the technical skills, how to learn the math, how to do the math, and give you almost 60, 70 different tools to do it with, spreadsheets, worksheets, those type of things. And then the second course uses the math, the skills, and teaches you how to execute with a client, how to have the conversations, how to build your offer, how to sell it, how to grow it. And there's a certification process after that, which is pass an exam and you become a clear path to cash professional. Now, I did want to say a couple things about books. I mean, I'm not here to sell books, but if you heard the math and you thought it was interesting and maybe you didn't write it down and missed it and wasn't in the show notes very well, Don't Be a Dumb Business Owner is a book of mine that I wrote, and all of the calculations are in this book. It's very well, spread out and not spread out, filled out to the point where you can follow along and do it in your own business. And the other book I wrote, Blaine, was a 7-minute conversation, how to analyze any business's financial statements in 7 minutes or less. And if you go to cashflowmike.com, download a copy for free. So that's 6 calculations on analyzing any business in 7 minutes or less. So appreciate you having me. This is fun.
Yeah, this was a fun time. And I want to say out there, everyone, I've read both these books and probably more than once. And really just concrete. That's what I like about it. It's concrete and actionable. It's not like, well, it would be really nice. It's like, here's the meat. Here's the meat and potatoes. And I really value that. And they're always worth checking that out and checking out cashflowmike.com as well to talk with Mike. And I've seen what you've done for businesses and we talk all the time. And I, of course, believe in everything you're doing there and really appreciate you coming on the show.
Yeah, grateful for our friendship. I appreciate it. Thank you.
And thanks, everyone, for joining us. Please share, like, subscribe so you catch all of our episodes on FinFactor. And again, if you're looking for a way to move away from those ultra-complicated spreadsheets, and the more complicated your business is, the more you should be coming and talking with us at Dry Run. We'll help you forecast that cash flow, manage it, model scenarios, like I said, roll up those budgets, but make it simple so that you can work with your team and with your finance pros, with your business owners, with your management team, all in one big team and get the most out of it. So come and visit us at dryrun.com. We'd love to show you what we got cooking here.